On the program today, central banks in 6 of 7 major African economies may be divided on interest rates direction as South Africa and Ghana raise rates. Nigeria's central bank begins its monetary policy meeting, decisions to be announced today. Hello and welcome. This is a special edition of Business Incorporated. Thank you for joining us. I'm Chimeze Obi Iwagu. But first, let's look at how some of the markets are doing this intraday. Here in Africa, markets in Nigeria and South Africa were in the negative territory. NGX index was down 0.03%. The JSE index in South Africa was down 0.50%. In Egypt, the mood was largely positive as the main index was up 0.25%. Kenya closed Monday's trading session on the downside, a whopping 2.15%. And stock markets across UK and Europe dropped to their lowest level in 3 weeks this morning as fears over pandemic lockdowns increase following the jump in infections. Also, we find out how much damage the supply chain crisis is causing to other companies with the latest flash PMI surveys of purchasing managers. Let's talk to Simon now. Hello, Simon. Good afternoon. So what is the latest PMI saying about how much damage the supply crisis has caused? All right, we seem not to have Simon there. We move on now. Here in African continent, central bankers in key African countries are unexpectedly surprising the market by hiking their rates owing to a spike in inflation rates. However, some are seen looking past a temporary spike in inflation and leave interest rates unchanged to support economies that remain vulnerable to the effects of the COVID-19 pandemic. Well, since the region's rate-setting committees last met, domestic food costs have been driving up price growth, with average annual food price inflation in sub-Saharan Africa accelerating to about 11% so far in 2021 from 2% in 2019, and that's according to the International Monetary Fund. Higher oil prices are also adding to inflationary pressures in nations that are net fuel importers. However, here in Nigeria, inflation numbers are set to be trending downwards. Well, the Monetary Policy Committee of the Central Bank of Nigeria has been meeting since Monday to provide forward guidance on the timing of a change in monetary policy stance. The meeting is the 6th and final one for this year, and coming at a time of fascinating developments in the domestic and external economy. All right, let's first see what some African central bankers have done or are expected to do as they meet this week. And we are starting off in South Africa, and as expected, the South Africa Reserve Bank was the first to fire the starting gun on monetary policy normalization, but economists do not expect the hiking cycle to be plain sailing. The bank on November 18 hiked its main repo rate by 25 basis points to 3.75% from its record low amid growing concerns about upside inflation risks. The central bank raised its consumer price index forecast from 4.4% to 4.5% in 2021 and from 4.2% to 4.3% in 2022. Well, the hike marks the first step to unwinding 275 basis points of cuts implemented since the start of the COVID-19 pandemic. But the Monetary Policy Committee split its vote 3-2, indicating conflicting sentiments within the Apex Bank as it looks to support the recovery while addressing inflation fears. Well, headline consumer inflation was a modest 0.2% month-on-month in October an annual climb of 5%. In his statement, Reserve Bank Governor noted that elevated oil and energy prices pose upside risks to the short-term inflation outlook. All right, let's look at Ghana. Ghana's central bank unexpectedly hiked its interest rate on Monday for the first time since 2015 to 14.5%, citing significant inflation risk. The governor of the Bank of Ghana attributed the decision to the country's sovereign bond that he says spreads widened markedly over the period as investor sentiments shifted based on fiscal and debt sustainability concerns, prompting some sell-offs by investors with spillovers on the domestic foreign exchange market. Well, analysts say the drivers of inflation are a supply-side cost push and not within the immediate remit of monetary policy. And economists at Accra's database also say a hike in the policy rate will only kill demand further, and that is why he expects that the rate will be held. Incidentally, the rate was actually hiked. In Kenya, the MPC is scheduled to meet on November 29 and is expected to keep its key rate unchanged for the 11th straight meeting as demand remains muted even after the government eased some COVID-19 lockdown restrictions. Analysts say the MPC would like to see a more entrenched recovery before changing the policy. The bank will probably keep a close eye on gross domestic product data and real economy indicators like electricity consumption to gauge whether the nascent recovery from last year's virus-induced damage is sustainable and consistent. And then in Angola, the central bank is expected to stand pat after raising its benchmark rate to a record high in July in an attempt to curb rampant inflation. Analysts say the MPC will wait to see how this year's rate hike and new measures by the government to counter inflation, such as lowering sales taxes and temporarily suspending import duties, filters through the economy. Many of the price pressures in the economy are seen as imported, and the pass-through from the central bank rate to inflation and consumer demand in Africa's third biggest oil producer is weak. Consumer price inflation in Angola accelerated to 26.87% in October as prices rose 2.06% in the month. And here in Nigeria, the MPC meeting started yesterday and the decision will be announced shortly. Inflation remains at nearly double the top end of the target band. It slowed to 15.99% in October, and analysts say slowing inflation should give Nigeria Central Bank some room to leave its key rates steady for a 7th straight meeting and continue to support an economy that's struggling to recover from its biggest contraction in 3 decades in 2020. The GDP grew by 4.03% in the third quarter, suggesting the economy is still struggling to recover from its biggest contraction in almost 3 decades. At its last meeting in September, the committee left all parameters unchanged. The November meeting ends today, and the central bank governor, Godwin Emefiele, will be briefing on the outcome in a few minutes from now. But let's get down to the conversation, and I have with me here an economist and the immediate past Director General, Lagos Chamber of Commerce and Industry, and the CEO, Center for the Promotion of Private Enterprise, Dr. Muda Yusuf, here with me in the studio. And also joining us via Zoom is a professor of economics and public policy at the University of Uyo, Professor Ekpo. Thank you very much, gentlemen, for joining me on the program.
Thank you very much, Neza.
Well, Professor, I have to start with you. First, let's look at sub-Saharan Africa. Ghana and South Africa has taken the bull by the horn to raise the interest rate, considering the rate of inflation in spite of their global counterparts like the U.S. Federal Reserve and the Bank of England insisting inflation is transitory and living rates unchanged. Do you think it's rather too early for central banks in sub-Saharan Africa to take this stance?
Well, thank you very much. It's a bit matter of being too early than the issue of how the economy is performing. What is surprising is South Africa, because if I get the data right, the inflation rate in South Africa is about 5%. So I was wondering why they had to hiken their policy rate to fight inflation. But for Ghana, I'm not surprised because Ghana has been battling with a high inflation rate, but it's about stayed about 11%, slightly above a double digit. So why are they hiking the deposit rate to, or why are they hiking it or increase it to maybe they want to push down inflation further because Ghana practice inflation targeting. And I think the inflation targeting is about 8% plus or minus 2 basic points. If I even South Africa also does inflation targeting. So if you use inflation targeting framework, then you have then you have to be very careful, and that's why I think you find some of these countries doing what they're doing. What also is exciting to me is the issue of Angola, because they are oil exporting like Nigeria, and they are very high inflation rate of almost 27%, and the policy rate is quite high, about 20%. So I think for most of the countries, based on the fact that they all still recovering from the pandemic, they are trying to see whether there could be a good mix between monetary and fiscal policy, while some of them want the fiscal side to do the work. But you know, with the pandemic, with the impact of the pandemic, the state of the economy, what we would call the recession that some have recovered from, was on both sides of the economy, both the demand and supply. And so you need more of fiscal and investment policies to get out of it, or at least to be on a recovery path. So, so the central banks will operate based on the realities of their own economies, not necessarily. I may be looking at the global trend than the other African countries. But for us in Nigeria, I think watching Ghana and Angola is very, very important, or not maybe South Africa.
Absolutely. And then talking about waiting for the fiscal authorities to actually do their part, that has always been what the governor of the Central Bank of Nigeria has always preached, that the fiscal authority would have to do their part. Dr. Muda, now Nigeria seems to be the only country recording lower inflation. For some analysts, the CBN may probably surprise the market by probably bringing down the rate, although some believe that, of course, it still gives the CBN room to leave its rate unchanged. Which way do you see for Nigeria in this case?
Well, what I expect is that the CBN should hold on to the rates as they are now. Because inflation rate at almost 16%, even though we have recorded consistent deceleration in headline inflation for the past 7 months or so, but 16% headline inflation is still quite high. And even more disturbing is the fact that food inflation is over 18%. So no matter how we look at it, inflation is still an issue in this economy. And when we talk about the CBN and monetary policy, for people who are entrepreneurs, of course, these issues of risk are important. But what they expect to see are 3 critical things. First is the area of credit, the cost of credit, the tenure of credit, and the access to credit. Those 3 critical variables as far as credit is concerned is what is much more paramount to those who are investors in this economy, because we need to make these conversations also a bit more pragmatic, so that those who are following us, particularly the SMEs, will be able to relate to what exactly the CBN is doing and how some of these outcomes can impact their businesses. So these 3 critical variables as far as credit is concerned is very key. I'm aware that the CBN has been doing quite a lot through a mix of its policies and all of that. The second major thing that the businesses like to see and hear from the CBN has to do with the foreign exchange. whatever policy measures we are coming up with, I know we talk about CRR, we talk about MPR, moving it all here and there. But as far as businesses are concerned, the issue of forex is still a major issue.
Absolutely, and that's part of what we're going to be dwelling on as this conversation goes on. But in the meantime, let's take a quick break, and then we'll be back to continue with this conversation in a moment. Welcome back. If you've just joined us, you're watching a special edition of Business Incorporated, and we're looking at monetary policy direction in the sub-Saharan Africa. While I still have with me Professor Ekpo, who is a professor of economics at the University of Uyo, and of course here in the studio I have Dr. Muda Yusuf. Professor Ekpo, let me come back to you. The IMF at its annual meeting in October said it is time for monetary policy authorities to begin to draw a thin line between inflation targeting and supporting economic growth in the face of rising inflation numbers. Now, because of the COVID-19 pandemic, we saw some kind of shift from inflation targeting to supporting growth. The U.S. Fed recently announced it's winding down its bond purchasing program, and recently Rwanda announced it will cut down its stimulus package. Do you see African central bankers, including Nigeria, perhaps now taper down on its stimulus support for growth and focus more on the inflation targeting mandate?
Thank you very much. See, there's a lot of confusion. Nigeria is not practicing inflation targeting; it's monetary targeting. You know, there are few countries in the continent like South Africa, Ghana, I think one other, that does inflation targeting. When an economy is at the stage we are in the continent and in Nigeria in particular, you have to encourage, you have to stimulate growth, and not deal with austerity. So the monetary policy will be geared towards stimulating growth, because it is through growth that you can develop. The problem I have with the IMF is that it's one size fits all. For Nigeria, the central bank, through its development functions, are not doing the right. I mean, the wrong thing. They are supporting the real sector. We might debate as to the degree or the extent at which they are doing that, but there's nothing wrong in central banks trying to stimulate growth in the African economies. So in that particular area, I don't agree with the IMF position, because if you don't stimulate growth, you are back to austerity. So even inflation, if you look at it, some of very few countries, the rates are quite moderate. And for Nigeria, I think we have almost a 7-month decline in inflation rates, although it's still very high in terms of the food, component. So the IMF position that they should not, central banks should not stimulate growth, but rather concentrate more on inflation targeting, I think it has to be taken.
Professor.
Yes.
I don't think.
Yeah.
I don't think that. Okay, go ahead.
I would say there's some link between inflation and growth. There's no question. There's some link, but that link has to be determined empirically, not for each country, not based on what the IMF is saying. Yes. Go ahead.
Okay. Well, absolutely. Let me take it now from Dr. Muda Yusuf. What's your stand on this particular issue? Well, when we look at central banks all over, the world, they are faced with a lot of monetary policy dilemma. We're talking about this inflation rate, money supply, and of course GDP growth and external reserve. Part of all the challenges that we also have here in Nigeria. Where do you see the trade-offs between, any of these variables or considerations?
Well, the central bank's stimulus or injection of liquidity into the system, I think it is good as a form of stimulus, especially given the context in which we find the economy. you know, the COVID, the depression, the recession, and all of that. But we have to also be very careful. We are dealing with a very serious inflationary situation. And the way things are going, I think we are beginning to see elements of a monetary factor in inflation. Because if there is too much of that injection of liquidity into the system, it also fuels inflation. Particularly coming from the perspective that CBN funding many of the times, are high-powered money. And when you are in the process of, okay, pursuing this development finance, that is fine. But again, we need to define the limits of some of these things, so that we don't say that in the process of trying to stimulate the economy and all of that, we throw in so much into the system and create even more serious macroeconomic issues. Already, CBN outstanding claims to the government, to the federal government, has been estimated at about 10 trillion by the Debt Management Office. These things have huge liquidity implications. And if you are talking of the poor, for instance, the biggest problem of the poor today is inflation, high prices, just as you have been seeing with the numbers. Of course, there is a cost push element, but we also need to watch out for the monetary aspects of these things, both from the point of view of monetization of deficits and this injection of liquidity. And more importantly, the quality of intervention. Because it's not just enough to throw money into the system. You can see how much the rate of default in some of these interventions, sometimes as high between 60 to 70% default. If this had happened with the normal commercial banks, I'm sure there have been some sanctions. How do you disburse in a way that you are having a default of almost 70%, especially around these anchor borrowers and all of that? So the quality of intervention also matters. Because what I hear most of the time is that, okay, we have disbursed this amount. What exactly is happening to the quality and also the impact? Because even as we speak, we still talk to SMEs. Access is still a problem. Access to finance is still a problem. That's why some of them, you know, they get loans and facilities at 25, 28, 30%, even as we speak.
Well, I think this is a part of the issues that the Vice President was trying to talk about some time ago. There doesn't seem to be synergy between the Monetary Policy Authority and the Fiscal Authority, particularly in some of these intervention programs. In any case, we will continue with this conversation, but we have to end Business Incorporated at this point, and then we'll come back for our MPC decision and where we will continue with this conversation. All right, that's it on Business Incorporated special for today. Thank you for watching. I'm Chimeze Obi Iwago.